Good day, this is part 5 of a 6-part series on the cost of capital, and in this session we're bringing all the calculations on the cost of the various cost elements together into the weighted average cost of capital of a company. So what is the weighted average cost of capital for a company? It is the price of its capital over the medium and long term. It is therefore consolidating all the sources of funding in their proportions and in their specific weightings, their contributions towards their total package of funding. And there's a specific way to do this calculation. In most of the sources you'll see it is a formula, but it is much easier to understand and to visualize when we do it in a table format and then use the concepts into the formula. But doing the calculation through a table like you currently seeing, it is much easier and easier to understand as well. So let's look at the various sources of funding, and that depends on the structure of the company and the capital structure specifically. It could be debt, various types of debt, bonds, debentures, etc. Preference shares, different types of preference shares, equity through retained earnings, or equity through new shares, depending again on what the company structure is. But let's use these four as an example. And taking the values as an example, 250,000 debt, 300,000 preference shares, 100,000 of equity of retained earnings, profits that's already retained in the business, and then 450,000 of equity that was issued. So the total of the funding in the business is 1 million rand. The next step is then to calculate the weighting of each one of these sources. So starting with debt, 250,000 of the total value of 1 million rands of funding in the business comes from debt. So therefore 25%, which is 250 divided by the million, is 25%, comes from debt. Similar to preference shares, 300 divided by a million is 30%. So 30% of our funding comes from preference shares. And the total should always be 100 because we've got 100% funding that comes from our various sources. So that's half of the formula when you look at the other sources. The next step is the cost of each one of these sources, and those are the discussions that we had in the previous few sessions: the cost of debt, the cost of preference shares, and the cost of equity. And for the numbers that you see there, please review those sessions so that you can have a good understanding of where they come from. But important with debt, it's always we need to remember that the cost that we apply in the weighted average cost of capital is the after-tax cost of debt. So it's the 12% minus the 28% tax benefit that we're getting. So therefore the revenue service is basically subsidizing our debt down to 8.64%. Preference shares, let's assume it's 11%, equity at 12% on the retained earnings, and then the ordinary shares at 14%. The next step is now to multiply the weighting with the cost. And mathematically we need to now be sharp, because we're multiplying 25% with 8.64%. But what we're actually doing is we're finding 25% of a number of 8.64. So it is a fraction, it is a quarter of the 8.64 that we need to calculate. So if you just in a calculator take 25% multiply with 8.64%, you will not find 2.16%, because a percentage is divided by 100. So we've got two numbers divided by 100, which is not now a percentage, because a percentage is just divided by 100. So to get to the 2.16, If you take 25% on the calculator and multiply with 8.64%, you need to multiply that with 100 to get it to 2.16%. And the same with 30% times 11, it is 3.33, and at the end we add all these weighted costs together to get the weighted average cost of capital. And there you'll see the weighted average cost of capital is 12.96%. It is not an average, because if you take the averages of the prices, you will not get to 12.96%. It is each one's contribution, and you'll see equity, which is fairly expensive at 14%, contributes almost half of that price, 6.3%. So therefore it's important that we use the weighted average cost of capital, because the different portions contribute towards the price. When you go to the formula is basically taking each one of these instruments, multiplying the weighting with the cost, and it is exactly the same as what we see on the table here. It is just visually easier to do it in the table format. Both are accepted in whatever calculation assessment. So what are the different types of weighting schemes that we can encounter? The first one is book value weighting. So we want to weight our costs of our funding on the book values, and we use the book values as the basis. This we find in the company's financial statements, but it is based on historic values and historic accounting values. But that is one method. That is the more consistent one, because it does not change that often. Market value weights is determined by the weighting and the market prices. And the market prices can be fluctuating significantly, especially when we look at big impacts on the markets. Then the market prices can significantly change, which significantly impacts our weighted average cost of capital. So we need to consider these elements when we use market value weightings. And then target weightings, that is when the board sits together and they decide what is the ideal capital structure of this business, and based on the ideal capital structure they set target weightings, and we can use that in our calculations as well. So just be careful on what the especially assessments refer to and which one you should be using, and make sure that you understand where to find those numbers. So that brings us to the end of the weighted average cost of capital, and in the next session we will take this concept one step further, where we are releasing or relieving some of the strict assumptions that we took on in